everyone. So, I'm just going to discuss uh, some important themes playing out in the capital markets today, globally, not just in India. And this is just an educational video, just to keep up with what is happening in the market, what my thoughts are. Uh, Obviously, apart from the market drawdown that we're seeing because of uh, the Iran war currently, tariffs prior to that. So those are sentiment driven market movements, and also they do have fundamental uh, reasoning behind them also, but that's not what we'll be discussing today. Uh, so just want to discuss two very different structural themes that are playing out in the market uh, globally, not necessarily in India, but definitely in the US and Europe right now. So the first thing that's happening is the proliferation of active ETFs in the market. So if you are already investing in the markets, you would know that ETF is stand for exchange traded fund. So when you buy or you sell ETFs, basically you're selling units of the underlying fund. A fund obviously is a pooled investment. Uh, it's a pooled investment. It's a basket of stocks, bonds, other assets as per the theme and the mandate of the fund. So most funds, most ETFs, the very concept of ETF for most people is a passive investment vehicle, right? Uh, just like an index is a passive, index funds are passive investment vehicles for most people, and most people invest passively via index funds. Uh, so index fund, they do nothing but follow the underlying index, whether that's a large cap or let's say a small cap index or something like that. And whenever the index changes, so the underlying addition or removal of stock in the index is then reflected in the fund, whether that's a mutual fund or an ETF, right? So what's happening, not to deviate too much from the point, what is happening in the US market is two things. First of all, the structure of investments is moving away from mutual funds to ETFs. There's a reason for that. And number two, people are moving, more money is flowing in active ETFs than passive ETFs. Okay. So first, let's address the first reason or the first theme. Like why are people moving away from mutual funds and going into exchange traded funds? Why are they moving into ETFs? So this is purely for tax reasons, and this is very different from how it works in India. Okay, so for example, let's say you are a mutual fund in America, and you're not an actively traded mutual fund. Instead, you are an index fund. So you're not actively buying or selling any stock at all. You're just following the index. So what could go wrong with that? So what happens is you have tens of thousands of unit holders, people who have invested in your mutual fund. Now, what happens is, let's say out of 10,000 people who have invested in your mutual fund, 500 of those people, or let's say 5%, 500 of those people, they want to redeem their investments. They want to sell their mutual fund units and get their cash back. That could be for a variety of reasons, uh, but that's not relevant right now. So let's say the index returned 15% that year, right? And you have not made any changes to the fund because the index, it did return 15%, but the underlying constituents of the index have not been changed. Let's just assume that for the sake of the argument. And even if they do change, they don't change so much on a quarter to quarter or 6 month to 6 month basis. They don't change a lot. Uh, but let's say there have been no changes, right? So now what will happen? The 15% gain is a capital gain. And when you sell that, you basically incur a tax liability. It could be a short term capital gain tax, or it could be a long term capital gain tax, right? Now, what happens in India is if you have invested in a fund, in a mutual fund, and if you sell in less than 12 months of holding those investments, in less than 12 months of your investments, that is considered short term. So let's say you're liable to pay 20% tax on your gains. But in India, only the person redeeming the shares is liable to pay those taxes. So what happens is whenever there is redemption in a mutual fund, the fund manager, how will he give the cash back to the investors? Well, he sells the underlying stocks, he sells the underlying shares in the right proportion. So let's say there's 5% net withdrawal. So he sells 5% of each share proportionally and gives the cash to the investors. Now in India, when a mutual fund sells a stock for a profit, there is no tax liability on the fund level. The fund is a complete has a complete pass through structure when it comes to tax. So let's say that when the fund sold 5% of its holdings, let's say the fund sold $100,000 worth of profitable stocks and distributed it to 500 people. Now, that $100,000 worth of profit will be taxed not on the fund. So, the fund itself, the mutual fund, will not pay any capital gain tax in India for that profit. Instead, the 500 people who have withdrawn $100,000 collectively, will pay taxes on it pro rata. Okay. And it doesn't matter whether those stocks were the stocks, the underlying stocks that were sold in the fund, it doesn't matter where they will it doesn't matter whether the stocks are sitting in the fund for 5 days or 5 months or 5 years. Okay, so whether the capital gain applied would be short term or long term does not depend on how long ago those stocks were bought in the fund. Rather, the people redeeming it, how after what time period are they redeeming their investments? So if they're redeeming it in less than 12 months, they'll pay long-term tax of 20%. If they're sorry, they'll pay short-term tax of 20%. And if they're redeeming it after a year, then they will pay long-term tax of 12.5%, regardless of the underlying dynamics of the fund. So in India, the tax structure of a mutual fund is extremely efficient. Whereas the opposite will happen in the United States, right? So if $100,000 worth of stocks is sold, the tax liability would be incurred by the fund itself, right? So, and it will be distributed amongst all unit holders, even if they do not withdraw, even if they have not withdrawn. So, the 500 people out of 10,000, they will pay their 5% proportionate share of capital gain taxes. The remaining 95% of the people who did not withdraw will also pay the 95% of the remaining capital gain taxes, although they did not withdraw any of their investments. Neither did the underlying stocks got sold, which were their stocks. Okay, so the 5% withdrawing people create a tax liability of the remain. They create a tax liability for remaining 95% of the people. Uh, so this is a highly inefficient tax structure for mutual funds, and this is overcome by having an exchange traded fund. So the same fund, the same stocks, the same mandate, the same investment strategy, the same fund manager, they're changing the wrapper, the corporate structure of the entity from a mutual fund into an ETF. And ETFs, they do not they don't have that tax disadvantage as mutual funds in the US. So the way a ETF works is fundamentally different in the US. So how ETF caters to the issue of avoiding taxes in a legal way is ETFs, they have a AP, an active participant, right? So let's say somebody wants to uh, sell the ETF and get their money back. Well, first of all, most of the time they're selling the share of the ETF from one person to another person, right? So the fund in itself does not experience much inflow or outflow. Uh, but in case that there's an excess demand or excess supply, in that case, the fund needs to liquidate to pay off the ETF shareholder, right? So in that case, what happens? Well, in that case, what happens is, let's say the ETF has, let's say, 10,000 units, right? And 500 of those units need to be redeemed at a net gain of $100,000. So what will happen is the ETF itself will not initially come into the picture. What will happen is ETF partners with an AP, an active participant, which is usually a bank or some other financial entity which has strong capital backing. The AP will buy those 500 units. The AP will buy those 500 units from the unit holder who wants to sell, right? So let's say those 500 units are worth $500,000 with $400,000 of invested capital and $100,000 of profit capital gains on top of it, right? So what happens is that the AP will buy those ETF shares from the unit holder. So AP will give $500,000 to the ETF holder, and AP will get the 500 units. All right. So the ETF holder who just sold 500 shares of the ETF, they are liable to pay capital gains on their end because they had invested $400,000 and they got back $500,000. So they're liable to pay $100,000 on their capital gain. Whether that will be short term or long term depends on their holding period. But so far, no tax liability uh, on the ETF itself. Now, what happens is that the AP will take those 500 shares and give it to the ETF company or the ETF structure, which is a separate entity. Uh, the ETF will take those 500 units of ETF shares and underlying shares, whatever are those underlying shares, uh, the ETF company will destroy. They will destroy 500 shares of ETF. So if there were 10,000 ETF shares in circulation, now there will only be 9,500 shares in circulation. So they will destroy 500 shares, and whatever were the underlying stocks of those 500 shares, it will hand it back to the AP, and AP will sell it in the open market at a margin. And so let's say AP bought it at, instead of buying at $500,000, let's say the AP bought it at $499,000, and the underlying stocks it sold at $500,000. So it made $1,000 in margin in the difference between bid and ask. So the AP got its money back and made a small profit. The unit holder got its money back, whereas the ETF did not incur any transaction, any sale as such. It just destroyed the underlying ETF, and there was no buying and there's no selling, right? There was simply a kind of barter between the AP and the ETF, where AP gave the shares, sorry, gave the ETFs. The ETF company destroyed the ETF and gave the underlying shares back. So this way, ETF completely avoids paying capital gains on any redemptions of the ETF shares. So this gives a huge tax advantage because the rest of the ETF holders are not affected by by this redemption, right? They don't have to pay taxes. They don't have to pay capital gain taxes on someone else's redemption. So this is the structural advantage. So that is why there are existing mutual funds which in the US which are converting to ETFs, and more ETFs are being launched. And people are there's a trend in the US that people are coming back to active management, active investments as opposed to passive investments, which is kind of the opposite of what's going on in India right now. In India, there's a move towards passive investments after 2 3 decades of active investment, whereas in the US now people are coming more towards active investment after decades of passive investments. So there have been I think 2 300 ETFs launched over the past 12 months, active ETFs, whereas only 5 or 7 passive ETFs launched. So more capital is flowing into active ETFs because people now want active strategy, they want the alpha, and they want the tax efficiency of an ETF. I think another reason that people are moving towards active management in the US, whereas people are moving towards passive management in India, is because the US market over the past 2 years has done relatively very well. So, whenever the markets do well, there are always fund managers who come to light for their stock selection because the tide was rising. So, some of the fund managers inevitably do well, and their stocks inevitably end up performing really well. So after every bull market, there is a tendency to move towards active management. Whereas in India, the markets have been stagnant for more than 2 years, right? The markets have been completely stagnant for more than 2 years. So people have lost faith in active management because uh, whether passive or active, nothing has given returns over the past 2 years, whereas active charges higher fees. So in a stagnant market, people move towards passive investments. So that's what's happening in India right now. So anyway, I just wanted to share this theme that's taking on in the global markets, especially in the US market. The other theme that I wanted to talk about, which I will in my next video, I'll try to post some market update, something that's going on in the markets on a daily basis. So the other thing that I wanted to talk about, which I will tomorrow, is the access of retail money in private equity, or you could say the democratization of private equity. So that's also a very interesting topic, and we'll get to that tomorrow. Thank you for tuning in.